What the bio? All right. Good morning, everybody.
As we gather together, we acknowledge the sacred land on which we reside. It has been a site of human activity for 15,000 years. This land is the territory of the Huron-Wendat and Petun First Nations, the Seneca, and most recently, the Mississaugas of the Credit River. The territory was the subject of Dish with One Spoon Wampum Belt Covenant, an agreement between the Iroquois Confederacy and Confederacy of the Ojibwe and allied nations to peaceably share and care for the resources around the Great Lakes. Today, this gathering place is still the home of many Indigenous people from across Turtle Island, and we are grateful to have the opportunity to work in the community on this territory. We are also mindful of broken covenants and the need to strive to make right with all our relations. Last but certainly not least, we acknowledge the people of African descent who were brought here against their own will or in search of a safe place to live their lives and raise their children. Reconnaissance des terres. En nous rassemblant, nous reconnaissons la terre sacrée sur laquelle nous résidons. C'est un site d'activité humaine depuis 15 000 ans. Cette terre est le territoire des Premières Nations Huron-Wendat et Petun, les Scéniques et plus récemment les Mississaugas de la rivière Crédit. Le territoire était sujet de l'alliance de la ceinture Wampum plat avec cuillère, un accord entre la Confédération Iroquois et Confédération des Ojibwe et des nations alliées à partager et à prendre soin pacifiquement pour les ressources autour des Grands Lacs. Aujourd'hui, ce lieu de rassemblement est toujours le foyer de nombreux peuples autochtones de toute l'île de la Tortue et nous sommes reconnaissants d'avoir la possibilité de travailler dans la communauté sur ce territoire. Nous sommes également conscients des alliances brisées et de la nécessité de nous efforcer de guérir toutes nos relations. Dernier point, mais non le moindre, nous remercions les personnes d'ascendance africaine qui ont été amenées ici contre leur volonté ou à la recherche d'un endroit sûr où vivre leur vie et élever leurs enfants.
Good morning, everybody, and welcome to our session for today. My name is Aaliyah Kara, and I'm your host. I am a business owner, business coach, and paralegal for Innova Case Services. Today, we will be having our session led by our facilitator, Sandria Goodall. Sandria is the owner of All Good Accounting, and it is a company that provides creative alternatives, accounting, and tax solutions that will move you and your business beyond your current boundaries. So with a solid foundation in accounting and bookkeeping, Sandria has been able to combine her expertise, knowledge in accounting and bookkeeping and taxes to provide services for startups, small businesses, corporations, and individuals. So without further ado, I will give the floor to you, Sandra.
Great. Can everyone hear me? Awesome. Well, thank you so much for that, Aaliyah. It's a pleasure to be here, and I'm looking forward to seeing how I can give as much knowledge as possible to everyone so that, they get the best and most from their tax return this season. So I will be sharing my screen, and if there are questions, Aaliyah, if that's possible, you can, of course, let me know, and I will do my best to stop and answer. So I'm happy to be of service to everyone today. So I will be sharing my screen. Give me a moment. Okay, great. Can everyone see my screen?
Perfect.
Okay, awesome. Okay, great. So this morning, we'll be looking at personal tax saving strategies. So these are your tax saving strategies that you could apply to your current tax situation for the year 2023. So one of the first things I always encourage anyone that's doing their taxes, that is for them to start a small business. Starting a small business is, I would say, is paramount in today's economy. Because I'm one of those believers who strongly believe that if you do want financial success, that will only come from having your own business. And why not have that ability and get a tax deduction for doing so? So looking at that a little bit further, if you're starting a small business, especially if you're starting without a business name, there is no registration fees required for that. And so there's a no cost. So that's another bonus. Usually when you start a business, especially in the starting years, you will incur what you have is net losses. And from that loss, you do have the potential to reduce all your taxes payable and get a refund of 100% of your taxes deducted from employment. So the idea here is to have a small business on the side, and of course, having a job, you do have a T4, you do get taxes deducted each year. If you're able to have, your business, then the losses or the expenses from there can reduce that potential tax payable, having you in a certain tax bracket and give you 100% of your taxes deducted from employment. Business use of home expenses, which you would not have otherwise, have a deduction for, you're able to claim that as a business expense. And you're able to carry that forward up to 5 years. Sorry for my throat here. Yeah, you're able to carry it up to 4 to 5 years if you don't use it in the current year. And expenses from business can be claimed on personal taxes and be claimed twice. So your rent, you could claim that on your personal tax and as well for business. Professional development, you could claim that for personal taxes as well as your business. So why not double dip? So right across the border, having and starting a small business is one of those great tax saving strategies that I would encourage everyone to do. Another one of the tax strategies is medical expenses. Medical expenses are claimed over a 12-month period. So that means if you have expenses from 2022, for example, so January 2022, then in your 2023 tax year, you could claim it, even though it was the 2022 expense that you incurred. because it's not by year, but over a 12-month period. And of course, this is one of those expenses that you and your spouse can claim. The idea is the lower income person should be the one to claim this expense, because only expenses in excess of $2,635 for 2023, and of course it goes up to $2,759 for 2024, or 3% of your income, which is on line 23,600 of your net income, can be claimed for the federal tax. So the idea is the person with the lower income can claim this. And in addition to this, if you pay into a private health insurance plan, which many of us do, you could claim that and reduce your taxes payable. Another one is donate to a local charity. The saying goes, if you give, you receive. And this is one of those saying that is true within the tax world. If you donate to a local charity, you're able to claim 15% on the first 200 and 29% on the balance over $200. Okay, so why not give to your favorite charity, help them out to provide benefit to society, and you at the same time get that additional tax credit. And if this is a tax credit because your income is below the bracket, below the claimable amount where you do pay taxes, then of course you could carry this forward, and you could carry it forward for up to 5 years. Okay. Political contributions. This is another one. A lot of us, especially in the Black community, don't take advantage of this one. And taking advantage of this one is really a good thing, because it gets you into the mode of voting, which we all need to get out and do, and for us to see more of ourselves out in the public, fighting for our rights as individuals in this society that we live in. So making those political contributions to those parties that you favor and want to see win and make a difference for us is also that ability. So keep your receipts for all these contributions that you make to your political party. And the way it works is that for the first $400, you get to claim 75%. And then amounts between 400 and up to 750, you get to claim 50%. And amounts over $750, you get to claim 33.33%. And the credit that you receive on your tax return, which is a good amount, is a maximum of $650. So for example, if you contributed $400, then you will yield something like $300, which is 75% of that amount. So you'll get $300 as a tax credit on your tax return. Again, feel free to ask any questions. Again, I'm running through these tax strategies for you to see for yourself in your life. And, if you need further explanation, I'll be more than happy to stop and give you that detail if I can do so. Another one is interest and carrying charges. This one, a lot of us are not very familiar with. It relates to fees to manage and take care of your investment. Now, there are investments and there are investments that this does not relate to. So we're not talking about investments to a pooled registered pension plan or to a registered retirement income fund or RSP or a specified pension plan or your tax-free savings account. We're talking about investments in exchange traded funds, in stocks. We're not talking about manage the fees that occur with commissions, but to manage these kind of investments and I encourage everyone, especially in today's world, to speak to a financial advisor, start investing into products that are out there, because you do get to take to write off these expenses that simply are available to you. And for example, like if you have your savings plan, in your life insurance is also another one. Some of us have certain types of life insurance that has a saving component to that. This is another example of where you could write off those management fees. All you do is go to the statement of fees charged on your account. So you look at the statement and look at the fees that has incurred on your on your investment, and deduct them, write them off, right? They're there for you to take advantage of. The only thing to remember about this one is that the interest and carrying charges are not deductible when incurring for registered account, as I mentioned earlier, RSPs and full registered savings plans and things like that.
Sandra, we have a question here.
Sure.
So it says, what if your medical expenses is less than the amount you are able to claim? Will you still get the tax credit? If not, how many years can you in total the medical expenses and claim later?
Okay, so if your medical expenses is lower than the 3% of your income, or the threshold that I mentioned earlier, which is about $2,635, unfortunately, you don't get that credit. And another thing with medical expenses is that you cannot carry them forward. So if you're not able to claim them within the 12-month period, unfortunately, they're lost. Hopefully that answers your question. There are other taxes that you could carry forward, but except the medical expenses, you're not able to do so. Okay, great. Moving forward, in the same page of the interest and carrying charges. So you have your investor, your manager who you speak to. You could write off their fees for investment advice. Why not? You could write those off. Fees that perhaps you haven't deducted for someone who assisted you with filing your tax return, like somebody like myself. If you have income from business or property, then you could write off those accounting fees, those consulting fees, and those legal fees. And a lot of us are not aware of that as well, but you can surely do so. Now, of course, if you do have business income and business expenses and things like that, on that income statement that you prepare, there is that opportunity to write off those expenses there. But you could, for those expenses in particular, those relate to the year that you are getting the help. And so if you haven't deducted those expenses for accounting and tax purposes, you could deduct them on your tax return under the interest and carrying charges. And most expenses you paid on money to borrow for investment purposes, you could also deduct, okay? But they're generally only if you use them to try to earn investment income, such as interest and dividends. So if you borrowed money, to invest in stocks and bonds, money to invest in other things, you can deduct the interest portion that you paid to borrow that money. And of course, if you and your spouse are together and your spouse doesn't need this carrying charges, they could transfer it over to you and you could claim that deduction for yourself. Okay. All right. Another biggie is employment expenses. Employment expenses, a lot of us, depending on the job you have, are allowed to claim certain expenses. And so this is something, one would speak to their employer about. And if your job requires you to spend out of pocket and you're not being reimbursed either by, allowances and by the mileage specific deductions, then your car expenses, your telephone, your office supplies, things like that, you are able to write off. What's required though is that you ask your employer for what you call is a T2200 form, which is a declaration of conditions, declaration of conditions form, or a form called a TL2 for transport employees, which are employees that drive trucks and so forth. And once you have them fill that form out, then you could claim these expenses. If you work on commission is another one. You're out there selling for the company. You could claim all your expenses to the maximum of the commission income that you earn. And so take advantage of these because that is your right.
The charge? I put on the charger last night.
Yeah, but I made it feel late.
No, you're
Another thing to keep in mind is these expenses that you pay out for employment purposes, you're also able to claim the GST back. This is another benefit to you. And of course, it's only claimable if your employer is a GST HST registrant, but most of the time, 99% of the time they are. So take advantage of claiming your GST on your tax return. It's under GST 370 on your tax return, and you're able to claim that back. Okay, all right, keep going. Tuition fees. All right, so a lot of us are sometimes going back to school, having your own business, things like that. Tuition fees is another big area that I would encourage individuals to take advantage of. So if you paid even as small as $100 in tuition fees, you could claim a tuition fee tax credit equal to 15% of the tuition that you pay. Okay, and so in addition to that, you're entitled to carry forward unused tuition, education, and textbook tax amounts. So you are able to carry them forward if you're not able to use it. If you're not able to use it, you also do have the option to transfer it to your spouse, common law partner, your parent, or your grandparents. Okay, and so that is the situation with the tuition fees. Disability tax credit. Now, sorry, I see Juliet Robinson raised your hand. Juliet, you could go ahead and unmute.
Thank you so much, Andrea, for all this information. My question is around what type of tuitions can you claim the tuition fee for? Is it only for universities and colleges? Is there a specific accreditation required? Or what if you took a course online with a leadership company?
Great question. Thanks for asking. Yes, so any eligible institution, educational institution in Ontario, so long as they're a registered education institution, licensed institution, you can claim this tuition credit. So it could be a private college, so long as it's a registered education institution. Does that answer your question?
Yes, thank you. I'm just wondering, how do we know?
Well, I mean, if depending on the course that you take, you get credits for it.
Okay.
Most of them that you take usually are a licensed educational institution. You could ask, but pretty much you don't have to be a university or a college. You can, so long as it's a licensed, registered licensed institution.
Okay, thank you.
You're welcome.
Sandra?
Sorry for my voice. It seems a little bit hoarse. I'm not sure why. Okay, the next one is the disability tax credit. This is a biggie. And the reason why it's a biggie is because you do have the ability to carry this back up to 10 years. And I'll explain it a little bit further. So the disability tax credit is a non-refundable tax credit. What I mean by non-refundable tax credit, I mean, it does not, you don't get money back in your hand because like you do get money back, but it's not like directly gives you money back. What it does, it reduces your taxes payable, which then gives you money back, okay? It helps people with disabilities or your supporting family member reduce the amount of income tax they have to pay. So if you have a severe or prolonged impairment, you may apply for this credit. And if you're approved, you can claim the credit at tax time. You do need to get approved by your family doctor. It's a form that you complete. I think it's a T2201 form that you would complete, submit it to your family doctor. They would fill out certain parts of it. You then submit it to CRA, and then CRA will either approve or disapprove you for this credit. So what are the amounts that you're able to claim? Well, disability amounts for the year 2023 is that if you're 18 years of age and older, you could claim up to $9,248. And if you're 17 years old and younger, you get to claim that same $9,428 in addition to an addition of $5,500 for a supplement for children, which equals to a total of $14,928. Okay, so all of this can really, really reduce your taxes payable and give you money back. Any unused amount of this tax credit can be transferred to a supporting family member. So if the husband has been sick and the wife has been taking care of him and he's not able to claim all of this, then of course the wife or whoever is supporting him can claim this for themselves. This amount is not refunded in that year, so you do have to take it or transfer it to that family member. And if you are eligible or deemed eligible for this disability tax credit by CRA, and of course, if you did not claim this disability tax amount, you may be able to claim it back up to 10 years. And again, what the CRA does is once you are eligible for this credit, they will automatically reassess your tax credits for the 10 years and then give you whatever refund you are entitled to. Okay. Another one is the home accessibility tax credit. With parents and individuals who are living with us who may not be in the best of health, what individuals are now doing is renovating your home. And the good news is, CRA and the government is aware of this and is willing and has been giving tax credit to individuals in this situation. So again, this is a non-refundable tax credit for eligible home renovations, or if you do alteration expenses to your home, whether it may be to someone to gain access or to be mobile, functional in the home, or reducing any risk or harm to that individual. You're able to claim an annual expense of up to $20,000, which of course, if you get that, then you will get a tax credit of up to $3,000, which is 15% of the $20,000. And the renovation or this home accessibility tax credit is mainly for somebody getting the disability tax credit, or somebody who is age 65 or older. Okay. Something new this year is what they call the multi-generational home renovation tax credit. Now, this is a refundable tax credit, meaning that it directly reduces your taxes. The way this one works is that it's a credit to assist in the cost of renovating an eligible dwelling to establish a secondary unit that enables a qualifying individual, in this case a senior or an adult who's eligible for the disability tax credit, to live with a qualifying relation. Would be like your parent, which, you know, your child, if it's your parent who's sick, or grandparent, parent situation like that. This secondary unit is a self-contained housing unit with a private entrance, kitchen, bathroom, sleeping area, things like that. And this credit is a value of 15% of the lesser of qualifying expenditures and $50,000. So if you spend $50,000, then you get to claim, you know, that amount as a deduction on your tax credit. The qualifying individual, again, would be somebody who is who's receiving the disability tax credit, and somebody who is 65 years of age and older. Okay, another tax strategy that I would encourage anyone to take advantage of. This one is called the Educator School Supply Tax Credit. Now, you don't have to be, you know, a licensed teacher, you know, working for any of the licensed board, but so long as you are a facilitator or you've taught somewhere, things like that, this tax credit would apply to you. And it's a credit that's available to educator employees to a maximum of $250. So for example, if you have to buy supplies and things like that, then you would take whatever that cost is and multiply it by 25%, and that would be your credit. And in this case, the maximum is 1,000 times 25%, and the maximum you could claim is $250. So anything helps, right? Okay. Going forward, again, feel free to ask any questions that may come to mind. Contribute to an RSP account. Most people I know knows this one, so it's a no-brainer. Obviously, if you contribute to an RSP, you can reduce your taxes payable immediately. Another thing that I would encourage others to take advantage of is what we call through the spousal RSP. And what does that look like? Well, in a spousal RSP, the higher income earner in this case would contribute to the RSP of the lower income spouse within their available contribution limit. Okay, so again, say I'm married and I am the higher income earner for my household, I would then contribute to my husband's lower income spouse amount. That way, I myself, you know, gets the tax deduction right now for contributing to my RSP, and later on in the future, when, you know, myself and my husband will now wanting to withdraw from this RSP account, my husband, who now has that RSP, can then withdraw it, being that he is the one in the lower tax bracket, and of course will be charged a lower tax rate. So that's how that one works. So I always encourage individuals who are married to take advantage of this strategy, you know, with your husband or your common law partner, contribute to their, you know, RSP room. And that way, not only are you getting the immediate benefit, but then the tax credit will come to you at the end. when you withdraw. Okay, another one is called the Canada Training Credit. This one started in 2019, and some of us, when we do get our tax credit, we notice that the amounts are changing. And yes, the amounts are changing because you get a credit of $250 each year. This is a refundable tax credit, and it's intended to help workers with professional development. Individuals annually accumulate $250 of credit room in a notional account to a maximum of $5,000. And you could claim this Canada Training Credit for tuition and other fees paid for courses that you took in the year. So again, it could be any kind of professional development relating to employment, relating to business. It includes tuition fees, assessment, auxiliary fees, any of those fees that you incur, you can write off under this Canada Training Credit. The qualifier for this is that, of course, you need to file your tax return, which I hope everybody does. Be 25 years of age or older and not older than 65 years of age. Be a Canadian resident and earn at least $10,000 of qualifying income, not exceeding $150,000. Okay, so if you're in that range, this Canada Training Credit is a great opportunity for you to take advantage of. Some workplaces have you go and do training, and maybe you have to pay for it out of pocket. Claim it here, things like that. Okay. Now, another question that may come to mind with this is, does this training credit work in relation to tuition? And yes, it does. You could claim both. The only drawback is once you claim your Canada Training benefit, then that amount that you claim gets deducted from your tuition fees that you pay. So that's how it works. You could claim both, but once you claim this, it gets deducted from the other one and kind of balances out. Okay. First home savings account. This is a biggie. This one started in April 2023. And I really like this one because there are a lot of benefits that one gets under this new tax strategy. It's a registered plan similar to what you call RSP, but not RSP. Let me explain. It's a registered plan, and it allows you as a first-time home buyer to save to buy or build a qualifying home, first home, tax-free up to $40,000. So the idea is for you to open this account, and you could open it at any of your banking institutions, and you can claim up to $8,000 in your first home savings account made up to December 31st, 2023. And you get this as a deduction for your 2023 income tax return. This is a great strategy because not only are you investing something for your future, you are reducing your taxes payable instantly, and you get to withdraw this money tax-free to purchase your home. Why not? You get all those credits in one. Now, people may be asking, like, okay, well, I'm not a first-time home buyer, already owned a home in the past, so that does not belong to me. I would think again, because the qualifications for this one is a little different. And the qualifications are, if you did not at any time in the current year before taking money out, or any time in the preceding 4 calendar years, live in a qualifying home as your principal place of residence that you own or jointly own. So you could have owned your home in the years past, not a problem. So long as you did not own a home in the last 4 years, then you would then become qualified for this first home savings account. So if you have been renting for the last 4 years, why not? So what I do for my clients that I do taxes for, especially for those that I see who are renting, I encourage them to go ahead and open this account. Put money in, doesn't matter how small, it becomes a deduction for taxes going forward. And again, it's tax-free when you deduct money out of it towards paying down on your first home. Another one is register as a corporation. So it ties into having a business. The business is growing and it's growing and it's growing and it's good. Now you're at the point where it has made you some money and now you're like, okay, what do I need to do? You need to register it as a corporation. Now, the idea of having a business is to make money, and of course, the money is going to grow. So if your net income from your small business puts you in a tax bracket to be taxed at 15% or higher, which is the case for personal taxes, because your small business is reported on your personal tax return. So if your income from your business puts you in a tax bracket that is higher than 15%, then the idea would be to incorporate, which will save you taxes on your taxes on your income from your business. Because once you incorporate, the taxes now that you pay will be as low as 9%. Okay, so the idea would be incorporate your business, right? And have that as a tax strategy for you going forward. Another thing that I do encourage individuals to do, especially with their corporation, you see, with a corporation, you could do so many things. Keep in mind, the corporation that you open is an entity on its own. It's considered an individual, right? It's a person that can open insurance. It's a person that can buy things. It's a person that can borrow money. And in this case, it's a person that can open an account called a capital dividend account. Not many of us are knowledgeable about this, so I want to share some insights about this account, and hopefully you can do your own research and find out how this account can be of benefit to you. So this is an account that tracks certain tax-free surpluses accumulated by a private corporation that may be distributed as tax-free capital dividends to Canadian shareholders of a corporation. I know that's a mouthful, but all it's saying here is this is an account that you could keep, that you get to keep tax-free money in, and it gets to be distributed to you tax-free. So there's certain amounts that goes in, and it's these surpluses by this entity, a person, your corporation, and it accumulates. And then it can distribute them to you tax-free. Because most of the time, when you take money out of your corporation or any business for that matter, you are taxed, right? You are taxed and maybe and possibly incur double taxation. So the idea is, in this case, once you open this account, you could take money out of your corporation tax-free. Now, I will elaborate some more on this account. So what are the components of this capital dividend account? The components, or what items goes into this account, are the tax-free portion of capital gains realized by the corporation, to the extent that they exceed non-deductible portion of the corporation capital losses. So what does that mean? In essence, if you have losses in your business, capital losses, maybe you sold an asset and it's a loss, and you have capital gains that you realize from selling things. So long as the capital gains exceed those losses, that's what goes into this account. So that's what that little blurb means. And I'll explain that in a little while with some examples. Capital dividends from other corporations. So if you have or is associated with other corporations, meaning if your husband owns a corporation and like yourself, they could transfer capital dividends to your corporation. Or if you're associated in line with owning more than 10% of another corporation, that makes you associated with that corporation. Another big thing that goes into this account is life insurance proceeds, net cost at time of death of a shareholder. So again, life insurance, that is set up with the corporation, the proceeds can come to the corporation and it gets in there, and then the proceeds get distributed. And we'll talk about that in a few minutes. And of course, the other part that makes up this capital dividend account is the non-taxable portion of capital gains distributed by a trust to the corporation in respect of capital gains of the trust. Now, I'm not an expert in trusts, so I won't elaborate too much on that, other than the idea is if you own a trust, that trust can also contribute the non-taxable portion of gains earned within that trust. All right, so looking at some examples. The life insurance proceeds that I mentioned earlier, how does that play within this capital dividend account? Well, for example, one, the shareholder. So, you are the shareholder of a corporation. Unfortunately, you die. Then the corporation gets the credit to this capital dividend account. So, for example, if your life insurance proceeds is $3 million, then guess what? It goes straight into this capital dividend account. Isn't that amazing? Then it gets to be distributed to your family tax-free. In addition to that, your family and your future generations can be paid out regular income from this account tax-free. Unfortunately, if you die, but this is a great tax strategy. A lot of wealthy people like Elon Musk and, these wealthy families, this is what they do. They have this capital dividend account. They have their life insurance proceeds set up that it goes into this account, and then it gets distributed to their families. And we're wondering where they're getting money from. Well, it's coming from this generational income. Without this capital dividend account, you would pay 1.5 or 1,500,000 in taxes, because it's the gains that you earn money from. So half of that is 50% you would be paying on your taxes. Why not let it go straight into this capital dividend account? Tax-free. Unfortunately, you will die, but your family and your members of your family get this money tax-free. Now, another example with this capital dividend account is, and again, I would encourage you to let your corporation be that person. Your corporation can buy property. It can own rental property. Have it own them. Put your rental property in your business name, in your corporation name. Why not? Why? Because of this capital dividend account. So for example, if you were to purchase, so say for instance, the corporation owns rental property. It was purchased for $1 million. You sold it for $2 million. You will have a capital gain of $1 million. Normally, you are taxed 50%, obviously, on capital gains. Of course, that kind of 50% changes from certain years, but let's assume that 50% is taxable income to the corporation. Of course, the corporation has to pay that. But then that other 50% gets credited into this capital dividend account. And then is paid out of the corporation tax-free while you are alive, you know? So have your corporation especially own these properties, because if you sell them, you're gonna, for you personally, you'll be paying taxes out of your pocket, and you know, it will be a lot of tax for you. Have your corporation own it. You know, the corporation from taxable income can pay for this, and you get to live off this other money tax-free. Why not? Now, this capital dividend account is also very important when it comes to partnerships. Each partner, for example, owns 50% of a company, maybe a value of 400,000. So owner one has 200,000. Owner two has another 200,000. How will you buy your partner's share if they die, right? Are you going to come up with 200,000 in cash out of pocket or borrow 200,000? To me, that's quite costly. With a capital dividend account, you can do the following. One, you take out a life insurance policy for yourself and your partner. So unfortunately, one of you died, the owner one died. Then that money, the 200,000, flows tax-free into the corporation. And once that happens, owner two, who's left, can use that to pay out or buy out owner one's shares. And you will use it and buy the shares of those individuals. Of course, you'll be paying, you know, the owner one's family, or you know, his predecessors who are left behind, and buy them out. And that's how you would get that money in order to own this corporation if you're in a partnership situation.
Sandra, we have a question, by the way.
Sure, go ahead.
And I did briefly address it, but I'd love if you could go over it. The question was, do you have to buy the life insurance from your business, or just have to open the account? If the business is closed, what happens to the insurance?
Okay, so I want to make sure I get the answer correct. So if you want to know if it's the corporation that has to buy the insurance, if it's the, sorry?
I see that Judette was the one that answered it. Would you like to just come off of mute and briefly clarify that?
Yes, I'm just listening in. Yeah, I just wanted to know if the insurance has to be on the company's name, or is it on the person's name who owns the company? Like, I'm not too clear about that. And if the company closes, what happened to the insurance money? So it got lost?
Great question. Yeah, so yes, the life insurance policy is tied to the corporation in that it will be in the corporation name with the beneficiaries as the shareholders, so to speak. So the, you know, when one person dies, then obviously the beneficiaries are the shareholders, and they get that, and the corporation itself gives back to these shareholders or beneficiaries. When it, say for example, the corporation closes out, then it's something where you would work with the your investment broker or your financial advisor to transfer that policy to you, or pay out that policy to you when the corporation closes, because this is tied into what I'm about to speak to, which is what we call whole life insurance policy. The corporation would own this whole life insurance policy, and this is the policy under which, you know, it's encouraged to have, because it has this cash value component to it, wherein this cash value allows you to have a savings account that is tax sheltered under Section 148 of the Income Tax Act. This means you're not paying tax on the annual growth of this money. The insurance company pays dividends back into these policies. And so this money is growing and growing and growing. And what a lot of companies do is use it as a leverage for their business, in the sense of taking out a loan or a personal line of credit, and they use it as a collateral to live off of. And they use it for retirement purposes, or generally live on, especially, you know, if this amount, it has accumulated to quite a few amounts of dollars, or it goes into this cash dividend, capital dividend account. Again, if the corporation closes, then it would be something where, you know, your financial advisor will work it out to give you the cash portion of this money, and or transfer it to wherever you want to transfer it, so to speak. And again, I am not privy to know, that's not my expertise in terms of, you know, how to manage it once the corporation closes. I am looking at it from the tax advantage point of view, but there are steps involved, especially in this case where you have the corporation with whole life policy. You know, there's fees involved, like guarantee fees, underwriting fees to consider, which can be quite costly, but in the end, the tax benefits are there for you. So hopefully that answers your question, Dede.
Yeah, that was clear. I was just wondering, and you clarified my question. To me, it seems like this would be a good option for a young person, because I'm assuming that the cost for this whole life policy would be less, and it builds up over time. So this would be a good idea for someone who is starting out a business to consider this. Thank you.
Right.
No,
Okay, thank you, Dede. Yes, in fact, obviously, we all know the time value of money, that, of course, money, you know, will accumulate and have a greater impact on a person who's younger if they start now with investing. But again, it's something to look into. You know, again, this is where you speak to your financial advisor to see what those fees are. You may be surprised, maybe it won't be as costly, but it'll be something for you to look into and see what's possible. We're looking at the cost versus the benefit of this situation.
Sandra?
Yes.
I also think it's super important for everybody to know, I know we're on the topic of the corporation, but that this in itself can work on a sole proprietorship as well. So you can still have a living trust, an inter vivo trust, or if you want to have an intestate will, those kind of things can still work with a sole proprietorship and a corporation. So don't just think that if you're a small business and you're registered as a corporation, that it can't work in your favor for the sole proprietorship. The only difference is that the liability changes, because as Sandra said before, as a corporation, you are your own identity. And as a sole proprietorship, your personal and your business liability is all intertwined.
Yes, thank you for that, Elia. And thank you. And yes, and the reason why I was focusing on the corporation part of it is because the capital dividend account, which one gets, so this money can then flow through to that capital dividend account and be withdrawn from the corporation tax-free. But yes, absolutely, one can do this setup with a small business as well. And this brings me to the end of my presentation. I do thank everyone for having me here. allgoodaccounting.com. You can see my email, my phone number. I do bookkeeping, quarterly, monthly, taxes, corporate, small business, payroll. And I like to focus on creative alternative accounting and tax solutions, guaranteed to save you money. And so I hope that what I presented to you today has given you some insight so that you can apply them going forward. Thank you.